Gold just staged one of its sharpest single-day recoveries of the summer, a $75 jump in a single session, and it's landing right back at a level that could define the next several weeks of trading. Here's the situation. Gold ended this week at approximately $4,089 per ounce, after hitting a low near 3,192 just 2 days ago. That's nearly a $100 swing in 48 hours. Silver, meanwhile, is sitting around $56 to $58 after its own brutal week, down nearly 10% in just 5 days before finding some footing late Friday. These moves are not random. There's a very specific story behind what's driving this market, and most investors are getting it only half right. Let's break it down piece by piece. The week started with one clear theme: the Federal Reserve. Chair Kevin Warsh has been sending unmistakable signals. After last week's hawkish pause, where the Fed held rates steady but leaned aggressively toward future tightening, markets started repricing the entire rate path. Right now, the probability of a rate hike at the September FOMC meeting sits above 63%. The probability of another hike by December is priced at around 80%. That's a significant shift from where expectations stood just a month ago. When rate hike expectations rise like this, three things tend to happen almost simultaneously. The US dollar strengthens, Treasury yields climb, and gold faces pressure. All three played out this week exactly on script. The dollar index, the DXY, pushed above 101.6, its highest level in more than a year. The 10-year Treasury yield settled around 4.40%. The 2-year, which is most sensitive to Fed expectations, climbed to approximately 4.13%, and at points was testing fresh 2026 highs. Real yields, that's the inflation-adjusted return on treasuries, surged to multi-month highs. For gold holders, that last part matters the most. When real yields rise, the opportunity cost of holding a non-yielding asset like gold goes up. Investors can park money in treasuries and get a real return. That comparison makes gold look less attractive in the short term, and institutional money flows reflect that math precisely. But here's where the story gets more nuanced than most people are framing it. The catalyst that actually triggered gold's drop below $4,000 midweek was not the Fed alone. It was a combination. The Fed's hawkish posture layered on top of progress in U.S.-Iran peace negotiations. Geopolitical risk had been a major support pillar for gold all year. When oil prices fell back toward pre-conflict levels as the Strait of Hormuz reopened and peace talks advanced, one key prop under gold was removed. Safe haven demand softened. The dollar looked more attractive. Sellers moved in. Gold fell through $4,000 for the first time since November 2025. A psychological break below $4,000 generated a lot of headlines, and a fair amount of panic selling from retail investors who had positioned for a continued rally. But what happened next tells you something important about the underlying market structure. Gold didn't keep falling, it bounced. By Thursday, after the May PCE inflation data came in broadly in line with expectations, not hotter, not cooler, some of that extreme bearish positioning started to unwind. The dollar pulled back from its peak. Treasury yields eased slightly, and gold reclaimed $4,000 and then added another $75 on Friday to close the week near $489. That kind of behavior, falling through a key level, triggering stops, then recovering sharply, is something technical traders recognize immediately. It's called a false breakdown, and historically it tends to precede a stronger directional move. The question now is, which direction? Let's look at the technical picture for gold. Gold is currently trading near the $4,089 to $4,090 zone, which is technically significant. That level represents roughly the 50% Fibonacci retracement of the decline from the May high near $4,595 down to the June low around $4,020. Holding above this level going into next week is constructive. Losing it, however, could bring the $4,020 level back into focus quickly. Below $4,020, the next meaningful support is less defined, which is why that level is critical. Analysts have noted that a sustained breakdown through $4,020 could open the path toward deeper historical support zones. On the upside, the first meaningful resistance sits around $4,100. A clean break above $4,120 with volume would shift short-term momentum back in favor of buyers, potentially targeting the $4,200 to $4,300 range where several moving averages converge. The RSI on gold has been recovering from oversold territory. MACD signals remain mixed, but are showing some early signs of a potential crossover. None of this confirms a reversal, but the technical structure is at a decision point. This is not a time to chase moves in either direction without confirmation. Now, let's talk about silver, because the story there is both more painful and more interesting. Silver had a devastating week. It was down approximately 10% in 5 trading sessions before recovering some ground late Friday to around $58. At one point during the week, silver tested lows near $55. For context, silver hit an all-time high above $121 in January of this year. That's a correction of more than 50% in roughly 5 months. Three forces hit silver simultaneously this week. First, the same Fed-driven dollar strength and real yield surge that pressured gold hit silver even harder. Silver is a non-yielding asset, so rising real rates cut directly against the investment case. Second, silver has a larger speculative component than gold. When institutional money liquidates precious metals positions in response to monetary policy shifts, silver tends to see more aggressive selling. Third, and this is the part that gets overlooked in a lot of coverage, silver's industrial demand story has not changed. The Silver Institute projects 2026 as the 6th consecutive year of global silver supply deficits. Solar panel manufacturing, infrastructure spending, and electronics continue to absorb supply. The physical market remains tight. What's moving silver right now is paper market dynamics, futures positioning, speculative flows, and real yield pressure, not the underlying physical supply-demand fundamentals. That disconnect between paper prices and physical fundamentals doesn't always resolve quickly. But historically, when it does resolve, it resolves strongly. Silver's RSI at the week's low point was sitting around 27, deeply oversold by any standard. That doesn't guarantee a bounce, but it signals that sellers have been aggressive and positioning is stretched. The gold to silver ratio, another metric worth watching, has widened significantly during this correction. When that ratio eventually compresses, silver tends to outperform gold on the way back up. One signal most investors completely overlooked this week. Major banks haven't abandoned their gold targets. They've just widened the range of outcomes. JPMorgan is still calling for $6,000 gold by mid-2026. Wells Fargo is holding a target range of $6,100 to $6,300. Those numbers haven't moved. Even Deutsche Bank and others that have trimmed their targets are still projecting prices significantly above where gold trades today. UBS specifically stated this week that they do not expect the Federal Reserve to raise rates in the near term. They're forecasting gold at $5,200 over the next 12 months, citing expectations that inflation will moderate, particularly the trimmed mean PCE measure that Chair Warsh is focused on. The central bank buying story also hasn't changed. Central banks globally have been purchasing gold at elevated rates throughout this correction. Mohammed El-Arian noted this week that falling oil prices, which reduce inflationary pressure, may actually free up more central bank reserves for gold purchases. That's a subtle but potentially important dynamic as we move into the second half of the year. The macro picture going into next week. Markets are heading into a data-heavy week. On deck, the June manufacturing PMI, the JOLTS jobs openings report for May, and critically, the June unemployment rate and broader employment figures. These are the data points that will either confirm or challenge the current hawkish Fed narrative. If employment data comes in strong and inflation pressures persist, expect another wave of dollar strength and renewed pressure on gold and silver. The bearish scenario puts gold back toward $4,020 and potentially lower, with silver retesting the $55 psychological level. If, however, employment cools modestly and inflation data starts showing early signs of softening, even marginal softening, that September rate hike probability could start to drift lower. In that environment, gold above $4,000 becomes a serious conversation, and silver has the most room to recover given how oversold it currently is. There's also a technical dimension to watch. Gold's next trading session opens Monday, June 29th. Forecasts have key support between $3,952 and $4,060, with resistance at $4,140. How gold behaves in that first session after a 2-day weekend will set the tone for the week. For silver, the $55 to $56.50 range is the line in the sand. A decisive hold above that zone, supported by any easing in Fed expectations, gives silver a path back towards $60 and eventually higher. A sustained break below $55 opens the door to levels not seen in many months. The psychology of this market matters right now. There's a significant amount of retail capitulation that happened this week. When gold falls below $4,000 and silver drops 10% in a week, less experienced investors tend to sell, often at exactly the wrong time. Institutional players are aware of this, and some are likely absorbing that supply. The smart money perspective at this stage of the cycle has historically leaned toward viewing deep corrections in bull markets as entry opportunities rather than signals of trend reversal. Gold is still up over 23% compared to 1 year ago. The structural drivers, central bank demand, dollar reserve diversification, deficit spending, and long-term inflation concerns have not fundamentally changed. That said, the Fed is the wild card. Chair Warsh's anti-inflation credibility is being tested, and if the data forces his hand toward another rate hike, gold and silver will face another round of selling pressure before the next sustainable leg higher. Here's what to watch and how to think about managing risk. For gold, the range to watch is $4,020 on the downside and $4,100 on the upside. A close above $4,114 with conviction would be the first concrete technical signal that the selling pressure is exhausting itself. Below $4,020, patience and caution are warranted. For silver, watch the $55 to $56.50 zone. The RSI and physical fundamentals both suggest silver is stretched to the downside, but oversold can stay oversold longer than expected when macro headwinds are strong. For both metals, next week's employment data is the swing factor. Position sizing matters. Chasing either direction before that data lands is a risk management issue, not an investment thesis. At the time of recording, markets are waiting for additional confirmation on the Fed's policy path. The next clear signal comes from the data next week, and that data will likely determine whether gold's recovery from $4,000 was the beginning of a base or simply a brief pause before another test of critical support. This is not financial advice. Every investor's situation is different, and you should always conduct your own research and consult a qualified financial advisor before making any investment decisions. If this analysis was useful, hit that like button. It tells me what content is most valuable to you, and if you haven't subscribed yet, now is a good time. I'll have full coverage of next week's economic data and what it means for gold and silver the moment those numbers hit. See you then.